Okay, so picking back up with your review here, number 16 is a closing statement question. And I know that because if I read through it and I go all the way to the end, it says, what is the net amount the buyer will owe at closing? That's a closing statement question, which means I need my 4 columns. I need to write out my 4 columns. I need buyer credit, buyer debit, seller credit, and seller debit. So just go ahead and draw those out. And now we're ready to go. We're ready to start looking at what they've told us here. It says the buyer's contracted to purchase a home for $395,000. We'll stop right there. That's going to be a debit to the buyer for $395,000 for the purchase price, and a credit to the seller for $395,000. Right? So we've dealt with that one. The buyer paid $5,000 for earnest money deposit. The earnest money deposit is a buyer credit. So we've got $5,000 for the earnest money in the buyer credits. Now remember, that doesn't go anywhere on the seller's side because the seller doesn't have that money. And the sale will close on September 29th. The buyer has already received loan approval for a conventional loan in the amount of $310,000. Well, the loan is going to be a credit to the buyer, so $310,000 credit to the buyer for the loan. Okay, we dealt with that. The lender is charging the borrower a 1% origination fee and 1/2 discount point. Remember, origination fees and discount points are loan expenses, so they're going to be based on the loan amount. So we want to look at that $310,000 loan. And the origination fee is 1% of the loan. And the discount points are going to be 1/2%, so 0.5%. That's $3,100 for the origination fee and $1,550 for the discount points. So we're going to go back up here, and those are buyer debits. Those are charges to the buyer. So we're going to have $3,100 for the origination and $1,550 for the points. And that takes care of those. So we can cross those out. It says the lender is requiring the borrower to deposit 2 months of real property taxes. Well, we have to find how much the property taxes are annually. And it says right here, real property taxes for the year total $49.56. So the property taxes are $49.56 per year. And if we divide that by 12, we find that the taxes are $413 per month. And they want us to do 2 months of those, so times 2 months is going to be $826. So it's $826 that goes in the buyer debit column, and that's for the tax escrow. Alright, so we've done that. And they also want 2 months of homeowner's insurance into the escrow account. Well, the homeowner's insurance will tell us is $480 a year. So that's going to be $480 a year divided by 12 equals $40 a month times 2 months is $80 for the insurance escrows. And again, that's a buyer debit, so we're going to do $80 for insurance escrow. So that's taken care of. And then next it says the homeowner's insurance premium for the first year is $480 and is to be paid at closing. So we're going to debit the buyer $480 for the insurance. Real property taxes for the year total $49.56 and have already been paid by the seller. So whenever we prorate property taxes, and we always have to prorate property taxes on a closing statement, we're going to write our 2 statements out. And the seller always owes from January 1 through the closing date. And the closing date in this case is September 29th. That means the buyer owes from September 30th through December 30th. So we ask ourselves, what happened outside of closing? It says and we dealt with the homeowner's insurance, and we marked that out. It says the real property taxes for the year total $49.56 and have already been paid by the seller. So they've already been paid by the seller outside of closing. We want to do the opposite. If the seller paid outside of closing, then we need to charge the buyer at closing. So we're going to circle the buyer's statement. Now when we talk about the amount the buyer owes, they owe for all of October, which is 30 days, all of November, which is another 30, all of December, which is 30, and that 1 day in September. So it's 91 days. And what we know about the property taxes is they're $4,956 for the year. So we can divide that by 360 to get to a daily amount. And when we do that, when we take the annual property taxes of $49.56 and we divide by 360, that gives us $13.77 per day. And again, we want to take that times 91 days. And that's going to equal a property tax proration of $1,252.77. Now again, if you've got $1,252, $1,253, anywhere in there is fine. You know, a penny up or down is going to make a difference when you multiply times 91 days. So anywhere around $1,252 or $1,253 is fine. So $1,252.77 is what we came up with. And again, we said that is the buyer owes. Buyer owes. So that means it's going to be a debit to the buyer for $1,252.77. $1,252.77 debit to the buyer and credit to the seller. $1,252.77 credit to the seller for taxes. And that takes us through everything except these additional closing expenses for the buyer that total $1,200. So, additional closing expenses that total $1,200, we're just going to fill in the expenses there in the buyer debit. And now we're ready to rock and roll. We can total up each one of these columns and determine how much the buyer needs to bring to closing. Well, when you total up the buyer's credits, you end up with $315,000. When you total the buyer debits, you're going to end up with $403,488.77. 403, 488 and 77 cents. And again, if you've got 403, 489, if you've got 403, 488 even, any of that's fine. Because they're going to want us to round our answer anyway. In most cases on the test. They didn't ask in this question, but usually it's going to be rounded to the nearest, $10, $100, something like that. Well, if we want to know how much money the buyer needs to bring to closing, it's going to be those two numbers minus each other. So, 403, 488.77 minus $315,000. And when we do that math, we end up with $88,488.77. $88,488.77 or $88,489. Either way, if they said to the nearest dollar on the test, they're both going to be the same answer. So you're good to go there. Alright, number 17. 17 is a seller net question, and the way I know that is by looking at the end, if I read through, it says, for what price must the house sell to the nearest whole dollar in either order to meet the seller's goal? So they want to know how much the property's got to sell for. Remember, with seller net questions, we're always thinking of the transaction as a pie chart, which is 100%. In this case, we need to group the percentages and we need to group the cash. Well, cash, we know we need $42,000 because that's how much the seller wants to net. She has to pay off her mortgage balance of $63,000. And she's also got $3,500 in miscellaneous closing costs. So if we add all those together, we end up with $108,500 in cash that we need in the transaction. They also tell us, though, that there's a piece coming out of this pie. The brokerage fee or commission is 5.5%, which leaves 94.5% available for the seller. So we're going to divide that into the 108.5. So 108.5 divided by 94.5% is going to be 114,814 and about 81 cents. They want it to the nearest whole dollar, so we need to sell that property for 114,815 to make it work. Number 18 says, if unimproved land in a resort area costs $152,460 per acre, what's the cost of a parcel of that land 200 feet wide by 350 feet deep, rounded to the nearest 100? So, whenever I have a dimension question, I like to first of all draw the piece of property that I'm dealing with, because I find it helps to have a visual representation. So we've got 200 feet wide, and then we've got 350 feet deep parcel of land. Okay? And what we know is that the land is priced at $152,460 per acre. Well, I've got to do one of two things. I've either got to get this into square footage, so I could do 350 times 200 to get the square footage, and if I do that, I've got 70,000 square feet. The problem is that I've got square feet and then I've got cost per acre. I've got to make those things match up. Cost per acre is not going to help me, but cost per square foot would help me a lot. So if I can take $152,460 per acre and divide that by the number of square feet in an acre, I'd end up with a cost per square foot. And that is $3.50 per square foot, which if I multiply times the 70,000 square feet, would give me a total cost of $245,000. $245,000 to buy that parcel of land. Number 19 says a house in the city has a current market value of $235,000 according to a recent appraisal. The assessed value from the last countywide tax valuation is $199,750. The tax rate is 84 cents per hundred in the county and 46 cents per hundred for the city. What's the total annual property tax on the property? So the question is, what is the annual property tax on the property? And if we remember, our T-bar for property tax looks like this. We've got the tax bill on the top, and on the bottom we've got the assessed value and the rate. And they want to know the property tax bill. They want to know this number right here. So that's going to be, that means the formula says we need to know the assessed value and the rate. So it gives us a market value and it also gives us an assessed value. This is a test of do you know which one to use. We want to use the assessed value. So it's going to be $199,750 times a tax rate of 0.84%. $199,750. Oh, I almost made a mistake. See, we all make them. It's not 0.84%. It's 0.84% plus, because we've got 0.84 in the county and 0.46 in the city. And if we total that up, that's $1.30. So this is going to be $199,750 times 1.3%, 1.30%. And that is an annual tax bill of $2,596.75. Number 20 says a single homeowner has owned and occupied continuously for 17 years a house that has an adjusted tax basis of $248,000. During his ownership, the owner has spent an average of $6,000 per year on routine repairs and maintenance. If the owner sells the house for $875,000 and has closing expenses of $57,000, how much gain on the sale will be subject to the capital gains tax? So we had to read all the way to the end to get to the question. How much gain on the sale will be subject to the capital gains tax? Well, the first thing we need to do is figure out how much gain there is on the sale. So when we talk about capital gains, remember we have two columns to deal with. We have the invested column, which we call the adjusted basis. And we have the sold column, which we call the amount realized. Both of those, the adjusted basis and the amount realized. So we're going to start filling these in. It says it has an adjusted tax basis of $248,000. Well, just fill that in then. During his ownership, the owner spent an average of $6,000 per year on routine repairs and maintenance. We don't care about any of that because those are not capital improvements. If the owner sells the house for $875,000, so he sells it for $875,000, that's in our realized column, and has closing expenses of $57,000, well, we need to subtract out those closing expenses for our amount realized. How much will be subject to the capital gains tax? Well, we have an adjusted basis of $248,000, and then if we take the amount realized over here and we subtract out the $57,000, we have an amount realized of $818,000. So our capital gain is going to be the difference between those two. It's $818,000 minus our $248,000 amount realized, so our adjusted basis. So our amount realized minus our adjusted basis, and that gives us a capital gain of $570,000. The question is not how much gain, it's how much gain will be subject to the capital gains tax. So then we always need to ask ourselves, does it qualify for the exemption? And the exemption is if I'm selling my primary residence, which I've lived in for 2 of the previous 5 years. At least 2 of the previous 5 years. So, homeowner has owned and occupied continuously for 17 years. So he definitely qualifies for the exemption. So then how much of an exemption? And then what they tell us is it's a single homeowner. So the exemption for a single homeowner is $250,000. So we're going to subtract out the $250,000 that's exempt from the tax, and we are left with $320,000 being subject to the capital gains tax. So a taxable gain of $320,000 on that sale. Number 21 says the principal balance on a mortgage loan is $126,450 and the monthly debt service payment is $789.52. The annual interest rate on the loan is 5.5%. What will be the remaining principal balance on the loan after the next monthly payment has been made? So they want to know the balance on a loan after a payment has been made. So this is where I make my little chart. So we've got our beginning balance. And then we've got our payment amount. And we're going to break that payment down into principal, interest, taxes, and insurance. And then we've got our end balance. That's always how we handle payments on a loan. So we're just going to make a little chart here. Alright. And they want us to do one monthly payment. So the beginning balance is simply going to be $126,450. We know that. We also know that the monthly debt service payment is $789.52. They don't tell us anything about taxes and insurance. Our total payment we just have to figure is $789.52. The annual interest rate on the loan is 5.5%. What will be the remaining principal balance on the loan after the next monthly payment's been made? Well, it didn't tell us anything about taxes and insurance, so those are zeros. There's nothing going toward taxes and insurance, at least of this monthly payment. Realistically, what they're asking us is, how much is this number right here? How much of that $789.52 is going toward principal? Well, the only way I can figure that out is to figure out how much first is going toward the interest right here. So let's take a look at that. If I go down here to the bottom, if I scroll down, my computer will let me scroll down. So if I scroll down, I can look at that loan balance of $126,450, and I can multiply times 5.5%. because that's going to give me my annual interest, which is $6,954.75 annually, which I want to divide by 12 because I need monthly interest, and that's $579.56 in monthly interest. $579.56. So I'm going to fill that in here. Well, what I know is this: my total payment's $789.52, and my interest, or the amount of that going toward interest, because we always pay the interest first, is $579.56. So if I subtract these two numbers, what I'm going to be left with is the amount going toward my principal. So $789.52 minus $579.56 would be the amount that's going toward my principal, which is $209.96. And now I know that if I look at the beginning balance and the amount I'm paying toward my principal, then I can get my end balance. Because the beginning balance minus how much I pay in principal is going to give me my end balance. So $126,450 minus the $209.96 that I'm paying in principal is going to give me an ending balance of $126,240.04. $126,240.04 for your end balance after one payment. Number 22 says a buyer wants to purchase a house for $92,000 and applies to a lender for an $82,800 conventional mortgage loan to finance the purchase. The lender determines that the buyer's monthly PITI payment would be $647.80. The buyer's recurring monthly obligations for a car payment and a school loan payment total $475 per month. What's the minimum monthly income, rounded to the nearest dollar, that's needed by the buyer to qualify for this loan if the qualifying ratios are 28% and 36%. So the question, what's the minimum monthly income needed by the buyer to qualify? So it's an income qualification question, or a loan qualification question, which means we're going to be working with the ratios, which means we need our two little columns here, 28% ratio and 36% ratio. And remember, the 28% ratio is all about the housing expense, and the 36% ratio is all about housing and debt combined. So they want to purchase a house for $92,000. That doesn't really impact us because what we care about is payments. And applies to a lender for an $82,800 conventional mortgage loan. Again, that doesn't apply to us because all we care about is payments to finance the purchase. The lender determines that the buyer's monthly PITI payment would be $647.80. That's the house payment. So $647.80 PITI is going to go in both of these columns. Because housing is part of both sides. So we've dealt with that. Done. The buyer's recurring monthly obligations for a car payment and a school loan payment totals $475 a month. Well, car payment and student loan payments are debt. So that $475 is only going to go in the 36% column. We'll just label that as debt. That takes care of this. Now I want to know what's the minimum monthly income needed by the buyer to qualify. Well, if we go back and think about our T-bar for buyer loan qualification, on top is affordability. In other words, how much of a payment they can afford, how much they need to afford. On the bottom is monthly income times the ratio. So, when we look at the 28% side, and the affordability is just these numbers on each side, by the way. On the 28% side, the math is going to be $647.80 divided by 28%. And that gives us an income needed of $2,313.57 per month. Over here on this side, we need to add these together. So $647.80 plus $475 is $1122.80 divided by 36%, and that gives us a necessary monthly income of $3,118.89. So again, we always ask ourselves, if I'm the lender, which borrower am I more comfortable with? A borrower who's making $2,300 a month, or a borrower who's making $3,100 a month? And the answer inevitably is going to be I'm more comfortable as a lender with the borrower making $3,118 a month. The question said how much it was the minimum monthly income rounded to the nearest dollar. So we want to come back down here and round this to the nearest dollar. If my computer would allow me to scroll. And round it to the nearest dollar, that's going to be $3,119 a month in income. Number 23 is a CMA problem. They want us to do a CMA on the property. But the first thing when you start doing a CMA, when you start making comparisons, is figure out what you need to adjust for. So for example, I need to make an adjustment for size because the subject property is 1,200 square foot and the first comp is 1,400, the second is 1,400, the third is 11. So I'm going to have to adjust for size on all three of these. So the question I ask myself is, how much is a square foot worth? Well, they don't tell me that. They don't give me that information. They aren't saying it's $100 a square foot. So I have to see if I can figure out how much it is per square foot. Well, the only way I can do something like that is if I have known quantities, and my comps are my known quantities. I know information about my comparables. I know what they sold for, and I know some information about them. So if I were trying to determine how much square footage was worth, I would look to see, do I have two comps that are exactly the same except for the square footage involved with them. So sale number 1 is 1,400 square feet, 2 bedrooms, 2 baths. Sale number 2 is also 1,400 square feet, 2 bedrooms, also 2 bedrooms and also 1 bath. That doesn't help me with a square footage comparison. Sale number 3 is 1,100 square feet, 2 bedrooms, 2 baths. Well, if 2 bedrooms is the same, 2 baths is the same, the only thing that's different is right here, the square footage, and of course, the sales price. So what that means is that the difference in sales price must be related to the difference in square footage. They're tied together. What we know is that whoever bought comp number 1 was willing to pay an extra $12,000 for some reason, because it sold, comp 1 sold for $124 and comp 3 sold for $112. So that's $124 minus $112 is a difference of $12,000. So that difference of $12,000 has to be related to the square footage, because everything else is the same about those properties. So $12,000 is what somebody was willing to pay for 300 square feet, because there's 300 square feet difference between these two comps. $300 square feet difference. If I take 12,000 and divide by 300, what I find out is that my square footage is worth $40 per square foot. Okay, well now I'm going to erase all these arrows here because it's going to get in the way about making my adjustments. So let me get all this stuff out of the way here. So now I can go back to doing my CMA like I normally would. I can make my adjustments. Here's what I know. When I compare comp 1, because now remember, when you make adjustments, you're comparing back to the subject property. When I compare comp 1 has, my subject has 1,200 square feet, and comp 1, or sale 1, has 1,400 square feet. That means the comp is better, which means I'm going to adjust down. I need to adjust down by the value of 200 square feet. And it's 200 times 40, which is $8,000. So that's a negative $8,000. Erase these as well. So now I can do comp 2 square footage. Well, it's also 1,400 square feet. And when I compare that back to my subject property, which is 1,200 square feet, I again need to subtract $8,000. And then I look at comp 3 and I compare it back to my subject property. Well, comp 3 is 1,100 square feet. Remember, my subject's 1,200, so my comp is worse, which means I need to adjust up. So this is going to be plus, and I need to add only 100 square feet. So 100 times 40 is going to be $4,000. So that's plus 4,000. So there's my size adjustments are done. So now let's look at bedrooms. Well, bedrooms are exactly the same all the way across. So I don't need to make any adjustments whatsoever for bedrooms. Those are going to be zeros. No adjustments. Okay? I'm going to erase that, get it out of the way. Erase these arrows up here and get them out of the way. So now my last adjustment is for bathrooms. When I look at comp number 1 and compare it back to my subject property, that to jump around on you. Alright, when I look at comp 1 and compare it back to my subject property, baths are the same, so no adjustment. But when I look at comp 2 and compare it back to my subject property, my subject has 2 baths, my comp has only 1. So I know that's going to be a positive adjustment because I need to add the value of a bath, but the problem is I don't know what a bath is worth. I've got to repeat the same process I did earlier for my square footage. I got to figure out what a bathroom's worth. So now I'm going to be looking for 2 comps that are exactly the same except for a bathroom. We'll look at comp number 1 and 2. Square footage is the same. Bedrooms is the same. Bathrooms are different. Sales prices are different. Doesn't that mean the things that are in blue are related to each other? That if everything else was the same, they must be willing to pay more money for that additional bathroom. And in this case, that more money is $10,000. They were willing to pay $10,000 for that extra bathroom. So that's the value of a bathroom. It's $10,000. So when we go back and do our adjustment, that's going to be plus $10,000. Now when I look at baths on comp 3 and compare back to the subject, I don't need to make any adjustments, so that's a 0. Well, I finally have all my adjustments in place. Finally, I can actually add up and see what this thing's worth. So if I look at comp number 1, I'm just going to bring these down here now. That's $124 minus $8,000. Well, $124 minus $8,000 is $116,000. Comp number 2 is $114 minus $8,000 plus $10,000, which is also $116. And comp number 3 is $112 plus $4,000, which is also $116,000. And so our answer here is B. $116,000. Alright, number 24, which is yet again another CMA question. It says the licensee is preparing a CMA in connection with listing a house for sale. The 2-story brick house is 12 years old and has 2,800 square feet of living area, 4 bedrooms, 3.5 baths, 2-car attached garage. Well, if I know I'm doing a CMA, I may as well go ahead and make my charts up. Subject, comp, and remember my first adjustment is almost always going to be appreciation. So I'm going to just go ahead and list that first. And now they start telling me about stuff. 2-story brick house is 12 years old, so age 12 years for my subject. Oops, didn't mean to move that around. Let me fix that. Okay, so if I scroll back up, I've dealt with the 12 years old. It has 2,800 square feet of living area, so size is 2,800 square feet. 4 bedrooms, 3.5 baths. So beds, 4 full baths is 3, half baths is 1. So we can get rid of that. It's got a 2-car attached garage and a large deck. Okay. So so garages, remember we list them separately. A 1-car, it does not have it. A 2-car, it does. It has 1 2-car garage. And then it said deck. So we're just going to put yes for the deck. And no significant upgrades. So we'll just go down here and we will list upgrades and put no. So let's see what our comp looks like. Licensee finds in the same neighborhood a very similar two-story brick house that sold 6 months ago for $325,000. So $325 is our starting point. And our appreciation is going to be plus 6 months. Okay, so we've got that filled in. We'll do the math in just a second. That house is 11 years old, so age is 11 years. And has 2,750 square feet of living area. So 2,750 living area. 4 bedrooms, 3 baths. 4 beds, 3 full baths, 0 half baths, a 2-car attached garage, and a large deck. So it has 0 1-car and 1 2-car, and deck is yes. And finally, recent kitchen upgrades valued at $18,000. So upgrades are just going to put yes. We'll worry about the amount when we actually do the adjustments. Okay? Current construction costs in the area, and then they give us all our adjustments. Okay, so the first adjustment we need to make is for appreciation. We need to look here. Appreciation. Our subject property, or a comparable property rather, sold 6 months ago. And what they tell us is that price appreciation in the area has been about 1% during the past year. Now, that's for a whole year. So if we look at $325,000 times 1% would be for a whole year. That's $3,250. But we haven't had a full year's worth, so we would divide that by 12, and that's $270. Excuse me, $270.83 a month times 6 months. So that's $1,625 in appreciation. And appreciation is always a positive adjustment, so plus $1,625. There's our appreciation adjustment. Well, if we go back, there's a difference in age, but they didn't tell us anything to do with it, so we're just going to assume that's a 0. No adjustment for age. Size. The subject's 2,800 square feet, the comp is 2,750, so the comp is worse, which means we need to bring the level of the comp up, and in this case we need to bring it up by 50 square feet. And what they told us is that square footage is worth of $115 a square foot. So our adjustment number is going to look like 50 times 115. And 50 times 115 is 5750. So that's going to be plus 5750 for our square footage adjustment. Now bedrooms are the same, so that's no adjustment. Full baths are the same, that's no adjustment. Half baths. My subject has a half bath, my comp does not. That's going to be a positive adjustment. So that's plus $6,000. So I need to bring the comp up. And they told me that the value of a half bath is $6,000. I don't need to make any adjustment for 1-car garages. I don't need to make any adjustment for 2-car garages. I don't need to make any adjustments for decks. I do need to make an adjustment for the upgrades. My subject is not upgraded. My comp is upgraded. So my comp is better. That means I need to bring the level of my comp down. The level of my comp needs to come down, and they told us that the upgrades were valued at $18,000, so that's how much we need to bring the comp down, is $18,000. Now, if we look at all that, and we total it up, we start with a 325, so we start here, and then we add, and subtract. Okay, so when we do all the math there, we end up with $320,375. as an indicated value. And of course they ask the question, rounded to the nearest $1,000. So if we round that to the nearest 1,000, our answer is simply going to be $320,000. Number 25. So the borrower has been approved for a 7.25% fixed rate 30-year mortgage loan for $172,000. The closing will take place on November 24th. How much interim interest will the borrower owe on a mortgage loan at closing? So how much interim interest? There's our question. How much interim interest will the borrower owe? Interim interest is always from the day of closing. So in this case, it will be November 24th. Through the end of that month. Remember, it's always that same month. In this case, that's 7 days. So we have 7 days of interim interest. Our loan amount is $172,000, and we're paying 7.25% annual interest on that. And if we do that, that's $12,470 in annual interest, which we want to divide by 360 days, and that equals $34.64 per day in interest times 7 days, and that gives us an interim interest charge of $242.48. $242.48 for interim interest. '26 is a long one, so I want to find the question, see what they're asking me. Based on these facts, how much money did the buyer have to bring to closing? So this is a closing statement question again. Anytime we have a closing statement question, we need to write our 4 columns. So we've got buyer credit, buyer debit, seller credit, and seller debit. We're just going to make the 4 columns here. There we go. Now we're ready to start filling in the information. So the buyer purchased a home for $125,000. Well, we're going to stop right there. $125,000 needs to go in the buyer debit, and it needs to go in the seller credit, because the purchase price is a credit to the seller and a debit from the buyer. Pay $3,500 in closing costs. Okay, so $3,500 in closing costs, that's going to be a buyer debit. Alright. At the time of loan application, the buyer also paid $450 for the appraisal and $50 for the credit report. This is tricky. You're doing a closing statement. You're trying to figure out what money the buyer owes at closing. This is something they already paid for. They don't need to worry about paying for it again. Ignore it. They paid $450 for the appraisal, for the credit report and the appraisal, $450 for the appraisal, $50 for the credit report. Great, good for them. We don't care about it on the closing statement. They've already done it. The buyer obtained a loan for 80% of the home's purchase price. Okay, so they give an 80% loan to value loan. We need to figure that out. That's going to be our $125,000 times 80%. So our loan amount, once we figure that out, is $100,000. And remember, the loan is always going to be a credit to the buyer. So we've got a $100,000 loan credit to the buyer. At an interest rate of 5.5% and close the transaction on April 30th. Okay, well, we may need that information. We don't know yet. The $1,200 annual property tax on the home was unpaid as of the closing date and will be paid later in the year by the buyer. So we got to do a property tax proration. Whenever we talk about a property tax proration, we've got our two statements. Seller owes January 1 through the date of closing, which is April 30th. And the buyer owes the remainder of the year. So that's going to be May 1 through December 30th. We'll remind ourselves what they said about the taxes. The $1,200 annual property tax on the home was unpaid as of the closing date and will be paid later in the year by the buyer. So the buyer is paying outside of closing. If the buyer is paying outside of closing, we want to do the exact opposite here at closing. If the buyer is paying outside, we want to do the opposite. That means we want to charge the seller. So that means we're prorating from January 1 through April 30th and charging the seller for it. So, we have 30 days in January, 30 days in February, 30 days in March, and 30 days in April. So that is 30, 60, 90, 120, 120 days. Now all we need to know is a daily rate. What they told us was that the property taxes were $1,200 for the year. So $1,200 for the year divided by 360 is going to give us $3.33 per day times 120 days, and that equals $400 that we're going to charge to the seller. So debit seller, credit buyer. So we got $400 that we want to debit to the seller and credit to the buyer. So buyer credit of $400, seller debit of $400, and that's going to take care of our tax proration. Alright, we'll go back here. So we dealt with that. So the $600 annual hazard insurance premium for the first year was paid outside of closing. Again, that's sort of like the appraisal fee and credit report. If it's paid outside of closing, we don't care about it. At closing, the lender collected interim interest on the buyer's loan. So interim interest is always from the day of closing to the end of the month. Well, the day of closing is April 30th. So that's April 30th through April 30th. 1 day. We only need 1 day of interim interest. Well, it's a $100,000 loan times 5.5% interest. That's $5,500 per year divided by 360 days. That equals $15.28 per day. And we only have 1 day, so it's going to be $15.28 debit to the buyer for interest. Let's get rid of that. And loan escrow account deposits for 5 months worth of property taxes. Okay, 5 months worth of property taxes. Well, here's what they told us about the property taxes. It's $1,200 a year. So we divide that by 12. That's $100 a month times 5 months is $500. So we're going to have a buyer debit for $500 for tax escrows. Okay. Plus 2 months of hazard insurance premiums. Well, we have to go back to that $600 premium right there. So that's $600 a year divided by 12 equals $50 a month, and 50 times 2 is going to be $100 because they want 2 months worth. So that's $100 for the insurance escrow. Well, that's everything they have given us about this particular transaction. So my computer is freaking out for a second. So, there we go. Alright, so we've got everything in here that we would need in order to calculate how much money needs to be brought to closing. We've got everything filled in about how much money needs to be brought to closing by these folks. So we just need to total up the columns. Right? If we total up these columns, I've got buyer credits over here in the amount of $100,400. And then if I total up my buyer debits, I've got buyer debits in the total of $129, $115. My computer's having a moment. I'll have to pause after this and probably restart. Hopefully it'll do. It's $129, $115. 28 cents for the total buyer debits. Of course, the seller credits are $125 even, and the only seller debit we had is the $400 in taxes. They want to know how much money the buyer needs to bring to closing. Well, that's going to be the difference between the two buyer columns. So $129, $115, and 28 cents minus $100,400. And that gives us a total amount that the buyer needs to bring to closing of $28,000, $28,715.28. And of course they wanted it to the nearest dollar, so we just drop off the 28 cents, and there's your answer. $28,715.